Without a stop, you are certainly risking the future of your trading career. Now, the issue with stops is that there are those times that your stop is taken out and the market just goes in the direction that you intended. Now, you try to juggle giving the trade room during volatile market conditions and not exceeding your dollar risk amount. But what's interesting is your stop, it's designed to limit your risk amount, but the nature of stops can allow you to exceed your risk amount depending on how volatile the market is. Look, stops are sitting in the market and act as limit orders. When they're triggered, they turn into market orders. Market orders are always filled at the best possible price, and a runaway market can have your stop price filled at a worse price than you originally intended. Now, if we agree that we need a stop in the market, where do we place it? Now, there are a few ways that can help you decide where your stop goes. You can use an average of the prices, such as a 20-period moving average. You can tuck it above or below trend lines. You can tuck it below horizontal support and resistance lines, or you can use market structure. Now, an easy way to stick to rules is to have your stop position rules-based. Now, let's base our stop on market structure. A market in a downtrend exhibits a pattern of lower lows and lower highs. Now, once this pattern starts to break down, we can expect at least a correction to this move that may start to take out the recent high. Higher lows are one thing in a downtrend, and they will give you a heads up to buying at higher prices. It's when the highs start moving up that you're in potential trouble. Think about this. If price is sitting at a high of 1.3500 and it's holding, there is selling pressure, resistance at that level. Now, once that price starts to increase, the selling pressure is moving up. When prices rise, the majority of people buy. The more buying happens once swing level highs are taken out. Now, the more highs that are taken out, the more people buy. Look what happens after a high is tested. Now, what do you think helped cause such a forceful move? Now, part of this thrust was no doubt a cluster of buy protective stops set as limit orders triggered into market orders. Now, this chart shows the progression of the stop placements. This execution is when price breaks a trend line, pulls back to retrace, and your initial stop goes above the beginning of the move. Now, the stop moves to above swings in the market after the preceding low is broken. The initial stop is placed above the number one swing because if price retraces over 100% of this move, it calls into question the entire short scenario. Now, why do we wait for the lows to break? Now, those lows are minor support when formed, and if the down move is still in effect, price should break the low. If the low holds, that confirms, at least temporarily, that there is support at that price level. If the stop is moved before that low is broken, you may get taken out of the trade if the market goes into a range. This is a simple way to use market structure for your stop and uses the way the market works. You place your stops and you can reap the rewards of trailing this way. Who really needs fancy indicators to do all of this?